Introducing Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. He's speaking to us from Gulf Shores, Alabama. Welcome back to the show, Tim, and best of the season.
Jim, thanks for having me, and happy holidays to you as well.
Tim, equities turned down from an earlier high in December and have recently been trying to bounce. What is the current situation with equities?
Well, the evidence continues to be, we had the four-year cycle top back in January of 22, and therefore the expectation continues to be that the advance out of this, the September intermediate term low, which was an intermediate term low, is counter trend. And that advance is currently at risk of having peaked. We're seeing a bounce here. I think that's kind of a retest of the high, but it looks like that intermediate term cycle is trying to roll back over, and if it does, that'll put us back in line to continue down into the four-year cycle low.
Oil has bounced a bit lately. What do you see there?
It's kind of a little bit different cyclical rhythm, but yet a similar situation as with equities. We had an intermediate term low there in September. That low has since been violated, and so that leaves crude oil set up to continue lower. And then the bounce we've seen this last week or so, that's it should be counter trend, and we should continue lower into some higher degree lows in 23.
Do you think after we get through the first quarter that oil will pick up again like it did this year?
Well, it's going to coincide with that's something I wanted to talk about overall with commodities, but it's something that's going to coincide with the 3-year cycle low, and we can talk about that in a minute if you want. But yes, I do see an uptick in oil and commodities into 23. I do.
What do you see with the advance out of the October-November low in gold?
It's very similar with, I say very similar. It's similar in the sense that the timing is different, but it's similar in the sense with, equities and crude oil. We had intermediate degree lows, in, November, and as of now, that advance is still intact, so it's bullish for now, but I do think it's counter trend and should be followed by, continued overall weakness.
What does this all mean for inflation in 2023?
Well, that kind of ties into what you was asking about a while ago, the 3-year cycle in commodities. There is a dominant, the dominant longer-term cycle that track is a 3-year cycle. And it last bottomed in the spring of 20, and, it's averaged around 39 months or so. So, it's coming up. It's due sometime in 23, and I cover that in my newsletter this last month in some detail, looking at some time frames and price expectations and so forth for that. But anyway, that low is on the horizon now. I'm looking forward in 23, and kind of like we talked about a minute ago or touched on, as we've seen some relief with oil and commodities in general, but we have this 3-year cycle low coming to you. So as we roll over into that low and turn back up, I think the inflationary pressures are going to pick back up, and of course I think it's going to lift oil with it. And like I said, in turn, we're going to feel a continuation of the inflationary pressures that we've all felt, you know, at the grocery store and everywhere else and everything, you know, every aspect of life basically. But as we turn up out of that low, I think, and these pressures increase, I think it's going to set the stage for one extreme or the other. And I think that either this upturn out of the 3-year cycle low is going to put enough pressure on the economy that the economy just can't take it, and it's going to lead to the final setup or the conclusion of the setup, or however you want to word it, and it's just too much for the economy to bear. And I think it would set us up for, a massive deflationary collapse. Or I think the other extreme is, if the cycle can continue higher and just continues, the economy can somehow manage to shrug it off, and we just see a continued grind with the, increased inflationary pressure just on and on and on. And God help us if that cycle does continue higher, for, a normal duration of what we'd call a right translated, 3-year cycle advance, then the pressures that we've seen with commodities thus far, I think is going to be, minuscule compared to what we could see there. So, I mean, it's like pick your poison. Neither one is good, but, I think I would prefer to see, the uptick conclude with a deflationary setup and some relief in prices. But, bottom line, we're going to see an uptick coming out of the low in 23. The question is, how much of that pressure can the economy stand before that cycle begins to roll over? And that's something I'll be monitoring, looking at the structure. It'll tell us, and we'll know. It definitely will tell us. But the short answer to the long explanation is, I do see a clustering of lows with commodities coming up in 23 ahead.
High-tech stocks took it on the chin this year. We're seeing some pretty significant layoffs as well. Is high-tech this year, along with the cryptocurrencies, kind of a shadow or an echo of the 2000 dot-com bust?
That's not something I've looked at closely specifically, but I can say, in November of 21, someone asked me, one of the subscribers asked me if I'd cover crypto, and it happened to fit into the setup with equities. And I covered it, and I said that I thought that crypto had made that 4-year cycle top. It led the top in equities, which, followed in January. And, as of this time, that 4-year cycle top is obviously still in place, and I think the decline into the 4-year cycle low is still ahead. Now, with crypto having led at the top, I think crypto will probably lead at the bottom. In other words, that it should probably bottom ahead of equities, I'm thinking, but I still think the 4-year cycle low is still ahead. So on the crypto side, I still think lower prices should follow. As far as, the tech stocks with the 4-year cycle low still ahead, I think any bounce should be counter trend, and they should continue lower as well.
We'll have more with Tim Cyclesman Wood right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what do you currently see for the U.S. dollar?
Well, the 4-year cycle low in the dollar last bottomed in January of 21. I think we talked about that way back then when it happened. We were expecting that low based on the statistics and timing and so forth, and we certainly got it. And in conjunction with that low, all the cycles of the smaller degree bottomed there as well with that higher degree low, and we had an intermediate degree low coming out of that that clustering of lows. And in the history of the dollar index, we've seen something with this advance we've never seen before, in that intermediate degree low within the context of the higher degree 4-year cycle advance, we've seen the most extended intermediate term advance in the history of the dollar index. And, I had written, or been writing in the letter and warning about this extended, intermediate term cycle advance, since I was worried about the snapback. Once it peaked, I was worried about the consequences of it. And, that intermediate term cycle, absolutely peaked, got a sell signal. It peaked in September. And, we're moving into a low, trying to find a little bit of a foothold here. But the dollar is at risk of that higher degree 4-year cycle top. I have evidence that it could have peaked, but I don't have confirmation of that. So that's something that we're going to be watching very, very closely in 23 and certainly the first quarter or so. This next little intermediate term advance and what happens with the structure should help clarify whether we've seen that 4-year cycle top or not. Like I said, I do see preliminary evidence that maybe we've seen that 4-year cycle top in the dollar.
Is a falling U.S. dollar good news for gold and silver?
Not necessarily, and let me explain why. I know this is contrary thinking, but if you look back, this is another first that we've seen. In conjunction with the most extended 4-year cycle advance, or excuse me, the most extended intermediate term advance with this 4-year cycle, or coming out of this 4-year cycle low and with the dollar, we saw the upturn with of the CRB and the commodity complex, gold included. And in looking at it, at a higher level, just looking at the CRB, the advance on the CRB was the highest single percentage advancing 3-year cycle in the history of the CRB index. That happened with the dollar going up. And so, that was a first, but it's a fact. And so, with the two going up, one concern I've also warned about why would you think that all of a sudden, just because the dollar's peaked, that correlation is going to change? Maybe it will, maybe it won't, but I have to go with the correlation that they went up together, and commodities has led the dollar on the downside here. So I'm not so sure that a weaker dollar is necessarily going to equate to stronger gold, silver prices. I do think that I see it setting up with where we see a general rise in the commodity sector because of the timing for the 3-year cycle low coming up in 23. But I don't necessarily see that with gold because of the timing of the cycles there. So I would not automatically draw that conclusion.
What about bonds and interest rates?
Well, with bonds, this rate hiking cycle has gone on far longer than I, expected that it would. And I think this has surprised a lot of people that somehow the economy has managed to, withstand the rate hikes that we have seen. And, and I've explained in the research letters, we've talked about it, I've shown evidence in the letters that this rate hiking cycle has been, the inflation that we've seen, I should say, has been a function, in large, from the supply chain issues. It's not been monetary. I'm trying to choose my words. And I've proven that, based on, the relationship with the dollar, et cetera. But anyway, that said, there is a 3-year cycle, dominant long-term cycle in bonds is a 3-year cycle. It's somewhat extended. We've been looking for that low, but there have been cycles of this duration or slightly longer. So I think that, once we get that 3-year cycle low in place on the long end, I say the long end on the long bond, then that'll be a pivot point, a technical juncture where we can see a capping of this interest rate hiking cycle. And I think we see that in 23 as well. I think that's something that's going to happen. Like I said, I am surprised. That's one thing I've been very surprised by, is that this interest rate hiking cycle has been, as long as it has, especially in light of some of the things we saw back in February that, have occurred at the top of rate hiking cycles, and it occurred before this rate hiking cycle ever began. So anyway, that's been another oddity with this, this whole interest rate hiking cycle and the, advance in commodities as well.
Now, we've talked about this before, saying that the inflation hasn't been caused so much by an oversupply of money or poor banking practices, but more from supply chain shortages and a war in Europe. And if you start taking those things into account, we're now getting used to it. Do you think these inflationary pressures will continue now that we're getting computer chips on time. Factories are opening back up supply chains and moving those supplies around. I don't think there's a rail strike. They seem to have that under control. Do you think this will calm inflation down and encourage the Fed to stop hiking rates and perhaps maybe by the end of the year or early next year start dropping them again?
Well, I do see that, but I don't see it for those reasons. Yeah. Fundamentally, I think those may be some explanations, but looking at it cyclically, like I said, there's a longer term cycle that it's actually a little bit past due here. I mean, I was looking for it, middle of this year, and it's extended on us a little bit. But like I said, there's, there is a precedence that it could still lie ahead. But I do think that once that long-term cycle in the bond market bottoms, that'll give us a foundation for the turn in interest rates. So yes, I see those factors, that cyclical bottom and the factors you mentioned, coming together where we do see a peaking of interest rates, yes.
Tim, before we go, can you just tell us a little bit about your research letter and what you do?
Well, basically, cycles is a method of trend quantification. And, when you can quantify the trend, then you can develop statistical-based expectations. And so it's a statistical approach to the markets. And by understanding the structure and the statistics, it kind of draws a roadmap for you. It allowed me, for example, it talked about the peaking of commodities back in the spring. In April, May, I first started seeing the evidence of that top, and everybody thought crude oil was going to $1 million a barrel, and we saw evidence of the top, and it's all based on statistics and structure, and we saw it. Another good example of understanding the structure and the statistics is that, I had this is documented in the newsletters, but last year in June of 21, I saw something that told me that we should see the 4-year cycle top within 6 to 8 months in equities. And sure enough, we saw slowly but surely it fell together. The actual top in equities was seen in January of 22. It came 6 months to the, pretty much to the mark. And since then, we've known that the rallies should be counter trend. The rally out of the June low was pretty convincing, just like this one was. But based on those statistics, we knew that they should be counter trend. So that's the kind of thing it helps provide. It makes sense out of what you're seeing, with the statistics and the cycles.
So overall, what's your roadmap, or what do you think is going to happen in the new year?
Well, in the new year, I think the 4-year cycle low in equity still lies ahead. Based on every indication, there's no statistical precedence that we've seen the 4-year cycle low. So I think that low is still ahead. I think that we see the 3-year cycle, a bottom in commodities. I think, and like I said, an upturn out of that low. What develops out of that low, like I said, something we'll be monitoring. My suspicion is that it sets up when something I'd call a left translated structure and sets us up for probably the deflationary scenario, but we'll see. And then, with the dollar, I think the surprise may be that we get the 4-year top in the dollar. Not 100% sure on that. We could have it at this point. And I see a turn in interest rates.
Tim, thank you so much for chatting with us, and have a happy new year.
Yes, sir. Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet if it's working. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.